They say markets crash by accident. But what if I told you the silver market was destroyed on purpose? Billions vanished overnight, investors were ruined, and behind the scenes, the real players were quietly buying up every ounce. And now, China is about to export silver like never before, setting the stage for the next global shock. Are you ready to see who will win and who will be crushed? These words echo not just as a question, but as a warning, the kind that jolts you awake in the dead of night because deep in the belly of global finance, something unprecedented, unseen, and chillingly calculated was unfolding. When the silver market collapsed, the public was told it was nothing more than a normal correction. Supply and demand, they said, market forces at work, buyers pulled back, sellers panicked. But any trader with experience knows that markets do not implode in the way silver did without external force. They do not freefall like a skyscraper whose supports have been severed. To understand what really happened, you must first understand how artificial crashes are engineered in the modern financial system. Not through one obvious act, but through layers of hidden actions, strategic positioning, and psychological warfare against all but the most informed. The engineered silver crash began not on the day prices collapsed, but months before, quietly, in the shadows of trading floors and dark pools of electronic exchanges where enormous orders are placed without ever showing up on public order books. These are the places where the big players operate. Hedge funds with billions at their disposal, banks whose balance sheets hide complex derivatives, and private consortiums coordinating positions across multiple markets. They began by borrowing massive amounts of silver contracts, not to invest, but to short, to bet on the decline in price. This isn't speculation. This is a wager against the entire ecosystem of silver holders. The borrowed contracts increased their leverage, and every strategic short position was a silent nail in the coffin of confidence. Small investors couldn't see this. Brokers didn't warn them. The media continued its usual chatter about market uncertainty and profit-taking. But behind the facade, the pressure was building. Then, at a moment chosen for maximum effect, a time when liquidity was low and the regular buyers were unprepared, the orchestrated sell orders began flooding the market. Not 1 or 200 lots, thousands, tens of thousands, and in some exchanges, hundreds of thousands. All triggered algorithmically to maintain pressure. Price breaks triggered more automated selling. Stops were hit. Margin calls were triggered. Retail traders, who had been riding the silver rally hoping for profit, suddenly saw their positions unravel in real time. Screens turned red. Brokers warned of margin deficits. The cycle fed on itself. But this was not random panic. It was the outcome the manipulators wanted. One day the price was climbing. The next, it was plummeting as if gravity itself had turned hostile. This is where the crash appeared to be natural, but it was far from it. Crashes engineered by big players feel chaotic on the surface because they are designed to exploit the reactions of everyone else. While the general public was bewildered, the institutions driving the strategy were not just prepared, they were profiting. And then, after the carnage, when prices had bottomed and confidence was shattered, the most audacious part of the plan came into play. The same entities who had pushed the market down began to accumulate silver again, but now at drastically lower prices. Mines that were struggling or undercapitalized were quietly bought out. Physical silver inventories that once fetched premiums began to trade hands in silent transactions. Vaults in key financial centers saw metal transferred under confidentiality agreements. The very players who declared silver's demise were quietly absorbing the metal they had publicly bet against. Meanwhile, analysts on television dismissed silver as dead money, too volatile, or out of favor. The perfect narrative to keep retail traders out and keep prices depressed. But this artificial calm was deceptive, like the quiet before a storm. The second stage was not restoration but control. The manipulators ensured price remained flat, stifled sharp rebounds, and kept perception weak. For months, silver hovered just above its floor, unable to mount a sustainable rally despite real physical demand increasing. Tech companies began reporting shortages in industrial silver components. Solar panel manufacturers struggled to secure supply for green energy projects. Photographic and medical industries, still reliant on silver for critical functions, began to see delays in deliveries. But the futures market, dominated by paper contracts, ignored the supply strain and appeared inert. This disconnect between physical demand and futures pricing was deliberate, a tug-of-war between real-world scarcity and paper market suppression. At the same time, mining output, which was already constrained by geopolitical issues and rising extraction costs, could not ramp up quickly enough to meet demand. Many analysts who recognized this disconnect advised investors to prepare for a long-term uptrend in physical silver prices. Yet, without a catalyst to break the manipulated equilibrium, the rally remained bottled up. That catalyst came quietly, and no one outside the highest echelons of global trade saw it at first. China, which had for years built a domestic capacity for silver production, refining, and storage, began to adjust its strategy. Instead of simply producing for internal industrial use, China started exporting silver in significant quantities, not in a frenetic dump, but in carefully calibrated shipments timed to soften spikes in global prices and to test the reaction of markets under pressure. Every export announcement was analyzed by traders around the world, but the true intention was obscured behind geopolitical and economic language about market stabilization and supporting global industrial growth. This was not random supply distribution. This was China positioning itself as a dominant force in the silver trade, capable of influencing pricing and supply chains. Nations dependent on imports began to notice, and some panicked. Middle Eastern and Asian industrial hubs that relied on stable silver prices started hedging aggressively. European financial institutions began scrutinizing their own exposure to silver futures. But China's strategy was layered, part economic, part geopolitical. By exporting silver, Beijing was asserting influence over markets that had historically been dominated by Western financial institutions. Markets are emotional systems, and the psychological impact of China's moves was profound. Investors questioned whether Western manipulators still held the same power or whether the balance had shifted. Confidence wavered. Rumors began spreading that China was holding more silver reserves than publicly acknowledged, a kind of economic leverage reserve not unlike strategic oil stockpiles. Every trade desk, every hedge fund, and every commodity analyst wrestled with the new reality. Silver was no longer just a market manipulated by financial institutions. It was a geopolitical asset. Meanwhile, back in the retail world, physical silver ownership surged. Bullion dealers reported longer delivery times. Premiums over spot prices widened. People who had once dismissed silver as volatile began to accumulate coins, bars, and physical holdings as a hedge against economic instability. The manufactured crash had inadvertently awakened a new generation of investors to the fundamental value of silver. And as physical demand climbed, the paper markets began to fracture. Futures contracts tied to silver started facing delivery pressure. Traders who had shorted silver found themselves squeezed as real delivery requests increased at settlement dates. Vault inventories were audited, and discrepancies were found between what was reported and what was physically available. A discovery that sent shockwaves through the system. Margin calls rippled across exchanges, and several major funds previously thought untouchable found themselves in financial distress. This amplified volatility, and for the first time in years, silver prices began a sustained upward trend that was not suppressed by manipulation. Prices climbed, first cautiously, then rapidly, as fear and demand collided. Investors who had been wiped out in the crash watched from the sidelines, stunned, as silver passed old resistance levels with astonishing force. Institutions that had triggered the original crash now scrambled to cover their shorts, buying silver at any cost to prevent further losses. This buying pressure intensified the rally, a feedback loop of demand that even manipulation could no longer contain. Global markets, already fragile from inflation concerns, currency fluctuations, and political tensions, felt the impact. Countries with large silver import requirements scrambled to secure supply, driving up premiums and creating a scarcity that fed back into the price surge. Headlines around the world began to shift, from dismissive coverage of silver's collapse to urgent speculation about shortages and spikes. Ordinary investors who had suffered losses found themselves vindicated, while the powerful entities that engineered the crash faced scrutiny and backlash. Regulators were forced to examine trading practices, short positions, and exchange rules. Some called for investigations into market manipulation. Others warned of systemic risks if such concentrated power remained unchecked. But even as authorities debated, China's exports continued, now serving a different purpose. Instead of suppressing price, they were stabilizing supply amid surging demand. This subtle shift signaled something monumental. The era of Western financial institutions dominating the silver narrative was ending. A new era was emerging where sovereign strategies, industrial demand, and geopolitical leverage intersected. And as silver continued its climb, markets began to price in a future where precious metals play a critical role in economic security, technological development, and national influence. The engineered crash, once seen as a disaster, became a catalyst for transformation. Investors realized that crashes are not accidents. They are strategies, deployed by those who understand the deeper currents beneath the surface. Tools are used to shake trees, so the fruit falls into the hands of those prepared to pick it. And by the time the world understood what really happened to the silver market, the landscape had already shifted irrevocably. Wealth changed hands, power dynamics evolved, and countries began rethinking their economic tactics. The question moving forward was no longer simply about silver prices. It was about who controls the supply chains, who dictates trade flows, and who can wield economic instruments as geopolitical leverage. China's role was central in this new narrative, and as silver continued to appreciate, the world watched, realizing that the next major shock in the market might not come from Wall Street, but from strategic decisions made in capitals around the globe. In this unfolding reality, the lesson was clear. The market is not a random force of nature. It is a living, breathing ecosystem influenced by power, strategy, and intent. And for those paying attention, knowledge of how crashes are engineered and how they can be survived is not just valuable, it is essential for navigating the next phase of global finance as silver emerges not just as a commodity, but as a cornerstone of economic resilience and power in a rapidly changing world.